So what is reverse mortgage? How they work? Who uses them and for what? And do you have to be desperate to get one of these loans? We're going to answer those questions as well as go over a 2023 guideline update right now. So the minimum age is 55 for a reverse mortgage in California. Not all states have the same minimum age requirements, and also not all reverse mortgage loan programs are offered in all states. It's important to note that. So with a reverse, you can access your home equity in a lump sum, in a one-time payout, or you can get a flexible line of credit where you can access the funds as you need them. There's no monthly mortgage payment required to pay back the reverse mortgage. That's the nugget. But there's a trade-off. It's not free. The portion of daily interest and charges that accrue that go unpaid gets tacked on the balance of the loan and gets repaid once the loan is paid off. So that means once the home sells or the loan gets refinanced. So this means the loan balance, if payments are not made, rises over time. But you can make monthly payments at any time in any amount that you like, and many people do. So for some people, this trade-off can make a lot of sense. Some people might ask, well, why not get a home equity loan instead? Well, it's not that easy. Some borrowers may not be able to income qualify to get a home equity line of credit. You have to have substantial income to get one. Sometimes people who get a line of credit when they were working full-time, the line of credit's usually only good for about 10 years or so. After that, it freezes. You have to reapply to reopen the line of credit. And maybe your income might have dropped by then, and maybe possibly a spouse passed away. They're not that easy to qualify for. With a reverse mortgage line of credit, the income qualifying is much easier because we don't look at the mortgage payment. There's no debt-to-income ratios that are used. So I have other videos on my YouTube channel that go into how to qualify for a reverse mortgage and the different types of reverse mortgages available. I invite you to go over there and take a look at those. We won't go into those right now. But just know that with the reverse mortgage line of credit, it can never be frozen, the line of credit, due to a drop in home values, as it can with a HELOC. Also, again, on the reverse mortgage, we don't use debt-to-income ratios to qualify for the loan. We use something called residual income, which is much more forgiving. So the requirements to obtain a reverse mortgage: the property needs to be in lendable condition. And what that means is that it can't be dilapidated. There can't be any type of health and safety issues on the property. Health and safety issues can mean a lot of things. So what I do is I tell people to send me pictures of the property so I can take a look at it. Maybe if there's an issue, if it's minor, maybe we can get a fix-it and a quote to fix it, and then cure it with funds with the reverse mortgage and give them 60 days after closing to get it fixed. If it's something that is more major in nature, that might need to be fixed prior to the loan funding. It just depends. So in 2023, an abundance of equity is needed. Since rates are up, that means loan amounts are down. So 60 to 65% equity is needed right now, April of 2023, to get a reverse mortgage. How do we come about to the loan amount that you are able to get? Three main factors: the age of the youngest borrower, prevailing interest rates, and the appraised value. Then it gets put into an algorithm, and out comes a loan amount. It isn't like a conforming loan where there's a debt-to-income ratio. It's much different. Credit profiles are important, but not necessarily determined on the loan amount, and they are relatively flexible for the reverse mortgage. Minimum age is 62 for an FHA HECM, home equity conversion mortgage. That's the one we see on TV all the time. But the non-HECM reverse mortgage is 55 years of age in California for the minimum age. So there's different types of reverse mortgages with different sets of guidelines. There's even now a second mortgage, reverse mortgage. Well, who would need that? For somebody who has a low rate on their existing first mortgage, say 3%, with a $90,000 balance, it doesn't make sense if they need a chunk of money to do something to pay off that low rate with a reverse mortgage, 7 or 8% rate. So, with a second mortgage, reverse mortgage, you leave the first mortgage alone, and we place the second mortgage behind the first mortgage. So you have two loans. But on the second mortgage reverse, you don't have to make a monthly payment on it either to pay it back. It's available in a lump sum at a fixed rate. Also, the hybrid reverse mortgage is something unique. If you get denied for, say, a HECM reverse mortgage due to a low value, there might still be a possibility to get a type of reverse mortgage. The hybrid is a loan where you pay a partial interest payment for 10 years at a fixed rate. After 10 years, you don't have to make any more payments. So that's another unique feature or unique type of reverse mortgage as well, and I have a video dedicated to it on my channel as well. Feel free to take a look at it. So you heard me mention that rates are up. But should people wait until rates come down to get a reverse? Well, home values are still pretty high, but they're kind of flatlining in some areas, poised possibly to come down. If the home value comes down, if rates come down because you've waited, you might have lost any gain in the form of a lower home value by waiting. So it's a good idea just to check into what you can get now, a non-committal type of a proposal on what a reverse mortgage might be able to do for you. Waiting might not be the best thing. It just depends on your area with where home values are. Now, the rates are not directly attached to the federal funds and prime rate. With the adjustable reverse mortgages, they're tied to the 1-year, 10-year LIBOR, 1-year and 10-year Treasury securities, and the 3-month LIBOR. You can get those rates on what they are in the newspaper. Every Tuesday they're published. In the financial section, you just look for the 1-year and 10-year securities, T-bills, and the 3-month LIBOR, and you'll see what they are at that point. So as the indexes go up and down, if you have a loan right now or reverse mortgage, your rates will follow that depending which one you're tied to. There are fixed rates available on the reverse as well. You just get less money up front. Here's some common questions we get with the reverse. Does your home need to be paid off? No. We use the reverse to possibly pay off that existing balance that you have now. Then you don't have to make a payment on it if you don't want to. So it's really good for cash flow that way. Will the bank own your home? No. You own and hold title to your home. Now in the 70s and 80s, this loan was not the greatest loan. That was not the case. But it has greatly increased since that time. A lot of people don't know that. Can a reverse lender foreclose on my home due to delinquent property taxes? As with any mortgage, yes, but for some reason people think it's only inherent with the reverse that happens. Any lender, if you are behind in your property taxes, they may have to foreclose, because if the county forecloses before them and gets their tax money and sells the home, they don't have to pay off the bank balance. The bank loses their entire balance. That freaks out a lender. So that's why lenders are more aggressive when it comes to delinquent property taxes. But there is help. There's something called HAF, Homeowner Assistance Fund. It's established in 2022, I believe in summertime, by the U.S. Treasury. It's a fund for people to be able to tap into and use if they're having problems that stem from COVID-19 problems, paying property taxes and utilities. Check it out if you have someone who has a problem catching up in their taxes and whatnot. That might be a place they can turn to. Do you pay income tax on reverse mortgage funds? No. It's not income earned. It does not go on your tax return. Do my children lose their inheritance? No. However, if you're not making payments, that means that you get less equity when the home gets sold. But you know, that's your equity to use for your quality of life. Don't necessarily worry about your heirs and leaving them everything that you can for them. That's yours. You worked hard for it. So use it to improve your life on a daily basis. Do you need to be suffering hardship to qualify? No. We do these loans for quite the affluent. People who need a bucket of money not in the market to dip into and avoid taxation. So there's several reasons why people would use a reverse, which we'll go into in just a moment. As I alluded to, some things that you can use reverse to: pay off that first mortgage, no more payments, flexible line of credit you could dip into that stays open the rest of your life. You can buy a new home with a reverse mortgage. A lot of people don't know that. It's basically a large down payment, and then we give you the balance in the form of a loan where you don't have to make a monthly payment to pay it back. However, the loan has to be on your owner-occupied residence. So if you're going to buy investment property, the loan must go on the home that you live in, and then you use the reverse mortgage funds to buy other property. People use the line of credit as a bucket of money to dip into, not in the market when investments are down, as I just mentioned. Silver divorces. Some spouses who want to stay in the property have a hard time income qualifying for a loan to buy out their departing spouse. The reverse can help in that area. And also to help their kids and grandkids and avoid income taxes as well are some of the reasons why people use a reverse. Some important things to know. Not all reverse mortgages are the same. There's different types and fee structures. Some are much less expensive to originate than others. Borrower counseling is required. A loan can't move forward if the counselor feels that the borrower doesn't understand what they're getting, which is a great thing. So some states like California have a 7-day cool-off period after counseling that give the borrowers even more time to ask questions before the loan can move forward to a loan underwriter. So in certain states, there is no 7-day cool-off, but just important to know that California that there is. Property must be owner-occupied for 6 months and 1 day per calendar year. No Airbnb, on the property that has reverse. You can, however, rent out rooms as long as you reside in the residence. If you're out of the home for 12 consecutive months due to health issues, the loan would need to be paid off. Property taxes, if during qualifying we see they have a hard time paying your taxes or you're habitually late, we may roll in several years of property taxes into the loan, and then the lender pays as it comes due. That's on a case-by-case basis. So what do you think of the trade-off? It could work for some people. It could work for many people. But for those who don't, it doesn't work for. I understand that as well. So if you have any questions in regards to how this loan works, or if you think you want to further explore it or have any questions and you live in California, feel free to contact me and let me know. Be glad to send you a video for your specific scenario. Also, if you don't even live in California, feel free in the comments below to ask any questions, and I'll get back to you and lead you down a path with an answer. Again, thank you so much for your time. Greatly appreciated. Bye.